Hello, everybody. We are here for the SoFi Weekly 2022 wrap-up. We're late because your boy Tevis was at a fancy little dinner. So, Tevis, you want to tell us what happened at this dinner and why you're late for the podcast?
I'm late because we do this on Friday night and people
And you have a life?
have
Is that what you're trying to say?
stuff to do. Yeah, exactly. That's exactly what I'm saying.
We are going to be recapping everything that happened with SoFi. Not really talking about the stock as much as more so going through what they did this year, how did they grow, and what we think could happen in 2023. So,
Let's first talk about Bender 9000 for a second. So, Bender 9000 is a commenter, a researcher on Reddit. He goes over a couple different companies. He does a lot of deep dives to the point where people think he's an insider. First off, let me just share this quick. These were Bender 9000's 2022 predictions. This was back in December of 2021. We would close out on a bank charter, student loans back up and running, buy now, pay later, Super Bowl being the largest marketing campaign for us. These are the ones that he actually got correct in his assumptions. The ones that he missed, student loans never came back in 2022. We did not launch SoFi Singapore. However, we do actually have a securities license there. So it's expected that we're going to be launching in the SoFi Singapore, similar to how we have Hong Kong. Same thing for the United Arab Emirates. Social invest platform never really happened. There wasn't an official launch of anything crazy. A securities income program, very similar to what Robinhood has, just allowing you to sort of collect a dividend to lend out your stocks that way. IPO investing really was no big launches like Vendor 9000 had predicted. And we still don't have a SoFi tax filing. I mean, he had an almost 70% success rate on last year's.
Some of these in 2022, now that I look at it, he's carried over into 2023. It's interesting to see the ones that he had for 2022 and how those have also carried over.
I wanted to look at SoFi as a whole. The stock has been a little bit in the dumps, and I just wanted to give people a little bit of a refresher on how SoFi has been growing. We're going to look at everything from Q2 of 2020 to Q3 of 2022. Obviously, I'd love to do a full year recap, but it's hard to do that without Q4. First, let's talk about members. We have seen almost 300% growth in our members in the last 2 years and 1 quarter. Products grew even faster than that, 300 and nearly 40%. Lending up almost 50%. Financial services up 655%. And our tech platform, after we bought Galileo Technisys, is up 245%. Whenever we look at the individual products, a couple things already stand out. Personal loans, large amounts of growth. Home loans, actually, surprisingly, large growth. Student loans, although there is growth, it doesn't look this pretty over this amount of time. SoFi Money, SoFi Invest, all unbelievable growth. Credit cards and referred loans, which is Pagaya, are both new, so they didn't actually have anything before this. And then, Relay and Atwork, obviously just growing at insane rates again, 600 and 750% respectively. Growth. This is just products. Whenever we start looking at the finances, this is for Q3. I wanted to highlight this. Net revenues up 111%, and the net losses are actually increased by 73%. Obviously not great, but this ratio is here to show you that we are closer to profitability. Adjusted EBITDA is growing, which is absolutely great. But let's jump into actual student loans. It's bad. For student loans, it's bad, guys. Origination volume shot down 42%. Average interest rate earned down 14%. The income recognized has grown because we're holding more on our actual books. Defaults are climbing 0.1%. Total weighted average. This is the amount it actually makes up for our loan department. So before, we were dependent on student loans by 46%. Now that's reduced to 25.9%. Average loan balance obviously decreasing because people are paying off their loans and we're not getting new loans back.
I think at the highest level possible, just for the sake of zooming out, yes, it's bad. And a lot of those metrics sort of point to that direction. But despite being our biggest business segment, it's still just one business segment in a very diverse business, which I think 2022 has shown us how diverse this business is with a lot of the new products that they've been launching. That's the grain of salt that I'm taking this with. It's like, yes, they're declining, but at the same time, this is a slice of that full picture.
Our entire home loan business, origination volume absolutely shot. Our FICOs, once again, they're lowering. They're still in great ranges, but our interest rate earned is growing like crazy because the Fed rates are really high right now. And that means that our interest that we're taking home from our home loans is going up a ton. Default rates stayed stagnant. Total weighted average for home loans has climbed a ton. All of this leads to a potential interest, the quality of the loans. These loans are more valuable to investors because default rates did not climb, but the actual interest rate did climb a ton.
I expected it to be worse, honestly. With the interest rate environment being where it is, like student loans obviously had the moratorium, and then home loans just had the macro. Obviously, we're going to see a very different picture when we scroll down and probably see personal loans. The other point I'll add on that, just in terms of products and in terms of originations, home loans is our smallest lending segment product.
You look at student loans, makes up 25.9% of our total lending business. Home loans makes up 8.8%. Personal loans, origination volume speaks for itself, going from 450 million to 2.8 billion. That's 525% increase. FICO scores are lower, but still very much within our margins. Our average interest rate earned of 17%. Interest income recognized is incredible, up almost 220%. This is also because we're a bank now. We're holding these loans longer. Default rates have been climbing. This is sort of what the bears are saying is the problem here. We've increased defaults by 0.8%. Hopefully that those interest rate earned will be able to obviously fund the unsecured part of our loans. The actual balance of the loans are getting larger. This is also helping with the amount of interest earned. And then the potential interest, it's skyrocketing, going way up 106.7%. Very, very exciting. This is our financial services. That speaks for itself. This was not the same business 2 years ago, obviously. It's a very new product back then. These are unbelievable growth rates. Technology services, this is Galileo at its infancy to Galileo to where it is today. But we owned Galileo back then. These are the numbers that they were putting up whenever we bought it for $1.2 billion. Now it's putting up numbers closer to these. I mean, this is also factoring in Technesis, but Technesis is tiny. Overall, this business has 4x'd itself in the past 2 years. What I'm looking at here is the total potential interest for all the loans and everything that we've looked at. This over here is Q2 of 2020. And then on this side, it's Q3 of 2022. So financial services, 2%, 14% for technology services. This is revenues. Lending makes up 83.6%. Where we are today, this shows a pretty interesting story about our diversification. Our financial services has exploded during this time, most in recent quarters, and hopefully looking to continue. Technology services has grown, and our dependency on our lending department is shrinking. 69% is a lot. It's still very, very dependent, but it is getting a lot better. So this is what I mean, that the longer that this takes, this doom and gloom to happen, hopefully the safer that we are, because by 2025, the idea is that SoFi is going to be a 30-30-30 split. Technology services, financial services, lending, and we will be very diversified.
Thinking about this longer term, I guess my whole thesis is that financial services is really going to become the cross-selling flywheel hub, right? And so I think 30-30-30 is definitely there from a dollar percentage wise, but from a product origination perspective, I want to see financial services start to eclipse some of these other cohorts because of that cross-selling. But obviously dollar amounts are going to be lending heavy because you're having huge loans like student loans, mortgages, stuff like that. But for me, let's say I have one mortgage or one student loan, but I might have 3 or 4 or 5 different products, which is where I see from an origination perspective, financial services being larger. One thing that contributed to this 83 to 69 is student loans being kneecapped for so long. But the other side of that is that that's been counteracted with personal loans receiving this huge lift from the Fed, basically. So you could argue sort of both sides.
But I just want to show you guys the difference in the market caps here. At the time that we went public, it was $21 billion. Today, it's $4 billion, an 81% decrease. I think that there were some numbers on there that didn't look great. I think there's some numbers in there that look phenomenal. I don't think it's an 81% decrease. And now I got to give a shout out to Chris Hager that showed an amazing tweet thread today where he showed off that this is not a SoFi only collapse in the stock market for fintechs. This is across the board. Every company are dropping like crazy. Very weird things can happen in public markets. Whenever I start to see the numbers change for SoFi, I'll be the first ones to ring the alarm bells. But for now, I'm confident to keep investing. Anthony Noto's not being loud enough about the love for his company, except he's putting his money where his mouth is. And maybe that's even stronger than a shareholder letter.
I would rather have that than a shareholder letter, yes, because I've had a lot of Alex Karp shareholder letters. I love them. They're philosophical, but he's not buying shares.
Yeah, it's also this old school versus new school communication with your shareholders. You have the Warren Buffett and Jeff Bezos, who, I mean, they've made full-on books that compile all of the shareholder letters of Warren Buffett and Jeff Bezos. And then you have CEOs like Elon or Anthony Noto that just mostly communicate through Twitter to their shareholder base. And it's more direct, it's more sort of off the cuff, and it's more frequent than a shareholder letter. If you take it at face value, it might sort of signal this old school versus new school way of communicating with investors. And also what is is your investor base in general? If you have mostly retails or mostly institutions, I kind of prefer the more frequent touch points as opposed to like one big shareholder letter, which I have to read between the lines to see if there's something hidden in between. Whereas I could just have a CEO that's just constantly tweeting out like new version of this will be out by midnight or whatever it is.
How much revenue are we gonna pull in 2022? And do you know
1.52
how much
billion?
revenue we brought in 2020?
Adjusted net revenue, Amit, we did about 621 million in 2020, and our guidance for this year is 1.52 billion. Trailing 12 months, as of our last report on Q3, we were at about 1.37 billion.
I didn't invest in this company during the IPO because I think the earliest I bought was $14 and on the way down, not on the way up. You know what? I probably bought too high. It was a market of free money. Rivian IPO during that time. I think they had not actually manufactured a car for production at that time. And yet they were worth like $100 billion or something. That it was an insane story. You know, were we overvalued at that time? Yes, that's what happens in very frantic markets. I can only look at this company in as many different ways that I can possibly see. Okay, website traffic. Can I compare it to its competitors? Can I look at its finances? Can I look at their product growth? I'm trying to look at it every single way I can. And in no way do I find it justifies a $4 billion market cap.
There was a duality because by and large, the market wasn't investing on valuations alone. Lucid, Rivian, what was the other one? Nikola, Charge Point, or like all of these ones were all story-based investments. And when you invest in the story, you can very easily decouple the valuation today and say, hey, look, whatever, this company is not going to make revenue until 2024, but when they do. And so that's how you got to some of these crazy valuations. And now when times are, tougher, you have a lot of people over-indexing on the valuation metrics, like the value investing.
Like Ray Dalio said, to win in investing, you kind of have to be a contrarian player. Was I right on SoFi as it was falling down? No, that was a mistake. Do I think I'm right now buying it at this valuation? Obviously I do, because I'm investing in it. I can't see of a reason that justifies this valuation. So I have to be a contrarian here, buy the stocks that are depressed and wait for it to go up. And that's just not the way retail investors like to buy.
What is the one or two metrics that you hold on to when you say the statement, I cannot justify a $4 billion valuation right now, which obviously means to buy?
I'd say probably price to book, because if we're going to get acquired, that's always the problem with people saying that this stock can keep going down. It's like eventually JP Morgan's going to scoop us up just for our assets under management. We're just going to get bought up because of our systems that we have, because of Galileo and Technisys. That's really the metric that I hold on to, where I go, are we not counting any growth at SoFi as if we're not going to see 60% more year over year members? At some point, you have to also include the fact that we are going to profitability closer and closer every single quarter. We will break profitability. And at that point, if the valuation stays depressed, there will be investors to come in. That's not what's keeping the stock down. Obviously, no investor is dumb enough to think that our growth rates aren't great. It's the survivability. Are we even going to make it there? That's what's scaring investors. It's safer to put your money in other stocks right now.
Two things, right? If we want to detach the emotions from it, and we can chalk a lot of the actions up over the past year or even 2 years more accurately, that it's been emotion, right? It's been euphoria and pandemonia. It's been fear and greed, respectively. If we want to just remove that and say, hey, look, the Nasdaq's down 34% year to date, SoFi's down, over 70% year to date. A lot of that is going to be emotion. Going forward into 2023, if you think logically about it from a numbers-based, sort of rational perspective, you say, well, look, the more it's fallen, the less likely it is to fall more, because you go into that book value method of valuation to say, hey, look, this company is actually worth something. They're actually producing, they're actually growing, so on and so forth. Therefore, if it's fallen to 4, can it fall to 2? Yes, but it's unlikely. Can it fall to 1 from 2? Yes, but it's even more unlikely, so on and so forth. And then you've got to go into this idea of saying, what is the risk reward that I get? Can SoFi fail along the way and not make it? Absolutely they can. But at this number, at $4 or at $3 or at wherever we land, the risk to reward ratio for you investing that money is in your favor, because there's minimal fat on it. You're trading at book or under book value. There's no bloat on that investment at all. It hasn't been hyped up as though you were investing in 2021. And so that's all we're saying. It's like, well, if we take the emotions out of the game, then what is the relative risk to reward ratio for you putting $100 in SoFi? If it goes bankrupt, you lose that $100. But if it doesn't go bankrupt, what can you make? And at this price, you can make a whole bunch more, because the market is basically giving you a huge discount for you to buy it.
So
let's look at this comment. The thought process is lacking nuance. And no, the book is not a sign of how undervalued it is. So we know the tone in that comment, but can we talk a little bit about price to book value? What is the counter argument for why it is a sign of undervaluation?
if we have a positive book ratio, more assets than liabilities, we can use those assets to pay back our debtors. And then the net amount of assets you can sell to investors. And that's called money.
You can argue price to book is not the best metric of how undervalued something is, but to say it is not a metric or it's not a sign at a $4 billion market cap when the stock is 80% down of how undervalued a company can be when they're going to bring in 1.52 billion in revenue, even if they're not profitable.
I want to just go back to a comment that Vitaly said. If you scroll up a bit, Amit, he had this comment saying the bottom is zero. And I think, guys, we need to establish a baseline on something. The bottom for any stock is zero. Apple, the bottom is zero. Like, you can make that argument for anything in the market. What we're saying is there has to be some rational argument that goes into play. Absolutely, I'm not advocating to use one single metric or even a handful of metrics. Like, you have to make an assessment based on many different factors that go into it. But there has to be some thought process as to what is a realistic bottom that is not zero. Because if you say the bottom is zero, then it's a binary event. It either goes bankrupt or it doesn't go bankrupt. Going back to my original point, that risk to reward ratio, if it does or if it doesn't, like, let's say it's 50-50. 50%, you lose all your money. 50%, you might make 5x or 10x. That's a good risk to reward ratio if you think of it in those extreme drastic terms, if the bottom is zero. But if you're saying that Apple or whatnot, a company that is profitable, that is not like SoFi, because I understand the case for SoFi being unprofitable, therefore they have a burn rate that when they get to a certain point, they have to raise more money, and that's the risk involved.
I think what Tannor was saying about probability, it doesn't make sense. If a stock has gone to 4, it is not more likely to go down from 3 if it was at 5 because it has more room to fall. Like, literally, like, so it could go down, but that doesn't mean it's more likely unless there's some catalyst that none of us know about that we're not factoring into a hypothetical that could push it.
So you kind of have to weigh the chances of a total collapse in the stock versus them continuing to grow 60%. And now it's not always a great sign to just look back at previous records. For example, let's say that ChatGPT is such a great product that OpenAI can throw out a product that is a competitor to Google. Because Google has been such an amazing company before, does not necessarily mean that the growth will continue just because we saw it previously. ChatGPT could bring their growth, into the negatives, and then going forward, people are using the search engine less and less and less because there might be a greater alternative. That's why we also try to look at SoFi in a way of who's our competitors? Would you rather go over to them or to us? There's a lot of great things with SoFi's actual products that I also think the growth is going to continue, that the total addressable market is increasing. We're increasing to new countries that we weren't in before. And all of those are tailwinds for our business. Whenever Tesla is at an all-time high and you're even seeing a bunch of new investors that didn't make any money on Tesla, Elon Musk is the cat's pajamas, That's another old saying. So we can add that to the list. Everyone's excited whenever everyone's making money. And then whenever the stock is going down, these are your worst enemies. Change out the CEO, do all these things, even though, we're going exactly where the fintech market is going as well. We're not underperforming in terms of our competitors at all.
I'm just looking at the chat. There's like a lot of back and forth around buyout conversations. And that's like a tantalizing topic to talk about just because it goes along with like a lot of the arguments that we're making with the stock being as cheap as it is. Institutions are also seeing that as well. And a lot of these big financial institutions are big holders of SoFi. It's definitely something that for 2023, maybe we want to jump into Bender's points. A lot of those are product focused, but there is a possibility, I would say a heightened possibility of a buyout in 2023 relative to 2022, as in there's more of a chance because, we're down 80% on our valuation since 2020.
In a bear market, it's merger and acquisition, baby. Like, it's time to scoop up the people that were undersold. If you did buy during IPO time, that sucks. If you're buying today, that's not a bad thing. If today we get a buyout offer, the people who bought today are going to be very, very happy campers. I guarantee you that. And stocks don't get bought out for the price that they are. There has to be a large premium for that purchase for everyone to sign off on it, for the board of directors to say, okay, as a fiduciary duty, this is the good thing to do for our company. We've had a buyout offer way back in like 2017, I think I remember, for $6 billion, more than we are today. Back in 2017, before the pandemic, before all those valuations.
But I think that Noto's stance has been pretty clear on the buyout, where he just feels that the inherent value of the ecosystem is much more than anybody would pay today. I mean, I think a buyout today, something like 15 billion wouldn't be out of the question, which is like 3x or 4x, depending on, where we end up from these levels. But I don't know that Anthony Noto would take that. I don't think he would, quite frankly. But it would probably be one of the bigger banks. Like it would probably like JP Morgan or Goldman would probably be my guess, especially because Noto also has the Goldman connection.
Let's jump into the last topic of the day. Vendors' predictions for 2023. Hopefully he gets 70% of them right again. The 23 potential catalysts for SoFi in 2023. Big wins for the tech platform. He talks about getting large financial institutions as clients. What do you guys think about that?
Like that quote from November is in the City conference, where he's basically like, hey, we have some people that we're talking to. The way that Noto is seeing it, it's a matter of when, not if, for these big legacy players.
Galileo products. These are the products that we've recently released. Direct deposit switch, pay in 4, fleet cards, dispute APIs, enhancements in the payment risk platform. I think that's with DataVisor, leading partner that we have for risk management. The upcoming products that Bender believes are coming, and this is in the roadmap: rewards programs, credit card programs, lantern style referrals, it's like insurance, and loans. Rewards could be massive if that's launched, for example, in the same way that Robinhood, one of our clients, if they do a rewards program, that could be absolutely massive for their type of audience, right? A younger audience, sort of build points. You can buy stocks with those points, use the card more. And then in the end, that comes back to SoFi because, those are our clients through their cash card.
Yeah, I kind of want to circle back to that rewards point as well, because again, I think it links into the ecosystem of the cross-selling with the shopping side as well. Basically, the idea is that they're going to have a wide diversification in the benefits of you being a direct deposit member or a SoFi Plus member in terms of what perks are available to you. And a lot of them will be B2B powered by Galileo, but as more and more are introduced from Galileo, like we saw with Buy Now, Pay Later, 2 weeks later, it becomes B2C SoFi branded content.
Galileo products launching is one of the biggest reasons I'm excited, because that's why I invested in this company. So it'll be really cool to see them make progress.
Retail CDs. How about this one? This is a great one. I love this. SoFi brokered CDs are a big hit. Brokered CDs help diversify funding, and retail CDs have a low cost of capital. Members are interested. Look for SoFi to directly offer retail CDs. I bet you there is a lot of people in the chat right now who have CDs. It's a great product, especially in this market. SoFi doesn't offer it right now. That could be absolutely amazing. I think that we kind of really need that to be a one-stop shop.
That would be interesting if they actually offer retail CDs. What's the percentage chance you put on that?
I mean, nearly 100. Now that we're a bank, it's a great product. Everyone wants it. And I'm sure it's not that hard to implement considering some of the other products that we offer. People forget how fast to innovate SoFi was, especially during the pandemic. That's no difference. We're just dealing with a lot bigger challenges.
All I have to say, just to wrap, similarly, to a lot of the charts that Tannor put up, I did some introspection on what did 2022 bring for SoFi, and I just summarized it all into this big Twitter thread. If you're interested, take a look at it. Not even for the individual points themselves, but just looking holistically, it will help you understand the rate of innovation at this company and the rate of new product introductions and how they're thinking about this whole ecosystem effect. It's very, difficult when the entire sort of stock is down over 70%. But when you see that every single month there is 1, 2, 3 new products that are launching consistently every single month, you start to decouple those ideas of saying, well, this is a stock that's down 70%. I'm very emotional about it, with this is a company that's consistently executing and innovating, and I should be very excited about it. So that's all I'll sort of have to say. And I think that, similarly in 2023, we can see similar rate of innovation or rate of new product launches, if not accelerated in 2023, because these things happen exponentially.
Thank you all for joining us on this journey. We started late October, and it's been an awesome couple months. So thank you everybody for joining. Appreciate the chat. 154
Happy
people
New
here.
Year.
Happy New Year. Please check out all the links in the description. Tevis, Tannor, all the YouTube channels, Twitters are there.